Questions before I move on? That's sales. When you create sales, the next logical step is you generate accounts receivable, right? You gave your customer terms. They're going to pay you eventually, hopefully in 30 days or less. So let's look at what the accounts receivable ledger looks like. Now this is that subsidiary ledger that we talked about. It's not a journal, it's a subsidiary ledger. And the analogy I used is that big box full of those index cards. Each customer has their own card, and we track what they buy and when they make a payment, and we calculate their ending balance every day. So if they call up and they want to make a payment, we know how much to tell them, right? Okay. So here's our buddy Roy Anderson again. His name goes on the top of his card. Here's his address. Very common date, description, starting to look real familiar, right? Post reference, really, really familiar. Debit, credit. Now in the general ledger, we had debit, credit, balance. But think about it, if the guy owes us money, the balance is always going to be what? What? Debit, right? It's a debit to us because it's an asset. So we just need one column for the balance. Good? Is he ever going to overpay us? Maybe, but probably so rare that why do we need to have an extra column on the paper? We don't. So remember the one example where we saw the sales slip. Roy came in and he bought some suit. So he had a balance from last month because he bought something then. We charged him $400 for it plus the sales tax for $432 total. His accounts receivable is $432. Here we are in this month, January. He came in and bought something else. It's on Sales Journal 1. He owed us $432 in total, right? So we add the two together. His new balance is $864. Everybody see how that worked? And we pulled this straight off of the Sales Journal. And when we do, we put that little check mark in the post-reference column. Good? And we do this every day for every customer. Yes, sir?
So when he starts paying off little by little,
we'll show a transaction here. But you'd have fifth payment, and it would come from cash receipts journal, and we'd have a credit, and it would bring his balance down. Okay? Now, so every transaction off the sales journal gets recorded here to each individual customer's card. If you take that customer, that box of all the customer cards, that's your subsidiary ledger for accounts receivable. If I add up the balance on all those cards, the total of all of those must always equal the balance in the one account on the general ledger for accounts receivable. So on the general ledger, you have one account, it has a balance. I know that people owe me $10,340. This is the drill down to find the detail of who owes me all the components that add up to that 10,000, whatever amount I just said. Good? Okay. Oh, here we go. Here's the sales journal. We're just going to follow it through. Date comes down, sales slip number comes down, post-reference number comes down, the amount, calculate the balance. Everybody good? We kind of walk through that. I won't duplicate it unless you want me to. Good? Good. Yes?
Not related. Unfortunately, I just want to let you know that we have to step out. She's not feeling good. She's my ride home. So
Okay.
To be brief without saying that.
Everyone say goodbye. Good night. Okay, and then the posting reference for this, because this doesn't have an account number or any sort of a posting reference, is just that you did it. It's just a check mark that I indeed did post it to that customer's account or card. I'm old school. I keep thinking of it as a card, right? But it's that customer's account.
Now, also through some of the other ones, you had to put the check mark for balance forward, because I think that one says the
That was in the general ledger when you put the beginning balance. Do you have a posting reference for that? Well, the post reference for the beginning balance in the general ledger is the post-closing trial balance of the prior month. So you've just put a check mark in there for that.
The second example down there has balance with a check mark, so I was wondering if
Yeah.
I was carrying it forward.
Just like the general ledger, here's his beginning balance for this month on this card, and we put a check mark in there saying, yes, we indeed put in the beginning balance. Okay? Okay. So here was your question about when he makes a payment. The guy comes down and he makes a payment, cash goes in. I know, it's great. Cash collected goes in the cash receipts journal. So if somebody pays you with a check or they hand you a cash at the cash register, it goes in the cash receipts journal. And that's the thing that was confusing you earlier, cash receipts. Or no, you had cash payments, but here's cash receipts. So we would, on the 7th, Roy made a payment from the cash receipts journal. It would be a credit because it reduces his balance. Do the math, calculate his new balance. Yes?
So what's the difference between the cash payment and then the cash receipt?
Cash receipts is money that people pay to us.
Yeah.
Cash payments is where we're paying our vendors and our expenses. Cash receipts is good. Cash payments is a necessary evil. Yes?
What if he pays with a credit card?
If I paid for something with a credit card,
He paid his bill with a credit card.
again, that's a cash receipt to us.
Okay.
Okay? Yes, sir? Okay. Because we still get cash. It may take a day or two to process through the bank, but we do get cash. Okay? We'll cover credit cards, I think, in another 2 chapters. Okay. Okay. This is a big deal. Remember we've created a new account for sales returns. When we sell something, the customer brings it back and returns it. We track that in a separate account. We leave sales alone. Just like when you buy a piece of equipment, say for $48,000, you leave that balance there forever until you sell the equipment, and you track the accumulated depreciation in a complementary account. So you always leave that $48,000 alone and you keep adding to the accumulated depreciation. We track sales in a sales account, but when we have a return, think about Macy's. I want to track it in a separate account to see how much returns I am getting. Is my return policy too lenient? Is it too strict? And also, there's a lot of cost and effort, of employees and things that go along with accepting a return. So I want to have an idea of how much my returns actually are so that I can watch what those costs are doing. And if I just net it against my sales account, right? Sales are a credit, so every time I do a return, it's a debit. How do I know how much returns I took? I don't. So we create a returns account just for that. Good? Okay. Sales allowance is another thing. It gets its own account in case we give somebody some sort of a discount or an allowance on goods. Right? If you go into Macy's and you go to buy a jacket, but the little gizmo that buzzes when you go out the door if you don't pay for it, right? If it's kind of torn the sleeve a little bit, you ask them for a discount, right? Or an allowance on the price. They track that in its own account. Good? Okay. Returns and allowances are a debit. Sales are a credit, so a reduction in sales would have to be a debit. Right? So you're debiting that and you're giving them their cash back. Your cash would have to go which way? Down, which is a credit. So returns and allowances always increase on the debit side. Good? But they're recorded right next to sales. They go in the sales section with all these other accounts that have normal credit balances. Good? Okay, they're complementary. They go together. They're connected at the hip. Yes?
Sales is the same thing as like revenue account and
Revenue, fees, income.
fees account.
Yes.
Just different name because we're in
because we're now actually selling things. Okay? Yes, ma'am?
Are those usually grouped together in one account or two separate accounts?
Usually two. Okay? Other questions?
How about a credit?
I'm sorry, I don't understand the question.
If I buy something and I call up and say, hey, this was damaged, they give me credit instead of...
That's an allowance or a discount.
All right.
Okay? Which would be a debit. Okay. All right. Here's our second favorite customer, Fred Wu, and his address. And this is a credit memo. So he bought something. He bought an athletic suit that he paid $150 for, and there was some sales tax along with that. And he brought it back because it was the wrong color, it didn't fit, it was damaged, whatever. We're taking it back as a return. Everybody got the concept? Good? Okay. So we're giving him credit for the $150. We're crediting his sales tax because now we don't have to give it to the government either. We give it back to him. And his accounts receivable balance would decrease by $162. Good? Okay. Does a return go in the sales journal? Think back to our sales journal. Was there a column for returns or returns and allowances? No. We do not have a special journal for returns. If you're in a company where they have so many returns that you need a special journal for it, they have a problem. Okay? So, this is going to go in which journal? General journal. Good? Okay. Okay, here we go. So we're going to debit sales, returns, and allowances. Right? We're not going to debit sales. We keep it in its own account. We're going to debit sales tax payable, reduce our liability, and we're going to credit accounts receivable, and we're going to reduce the amount that he owes us. This is going to also get pointed where, or posted where? His individual customer card, remember? So we keep track of his balance on his accounts receivable subsidiary ledger, what I'm calling his customer card. Good? All right. Oh, yes, it gets posted in two places. So here's the key to this. Remember, we talked about this and we said it gets posted to the general journal. Here's what it looks like in the general journal, except it's a different customer. Thank you. So we debit sales returns, we debit sales tax payable, we credit accounts receivable. Boom, boom, boom. Notice the posting reference. It's straight to the general ledger account for returns and allowances, a debit to sales tax payable, a credit to accounts receivable, which is 111. Notice there's a slash and a check mark. The slash and the check mark says that I've also now posted it to that second place. That's his customer card. So it needs to get posted in both places. Okay? And you've got to show that it got done in the posting reference. Cool? That's pretty cool. When you see it all work and the mechanics of it, it's pretty cool. Oops. So what do we got? Oh, here we go. Here's a different customer. Here's the example of posting the credit memo. From where? General journal. Credit of $486, and you calculate the new balance. Good. We happen to have famous customers, but nobody knows who that is, right? Yeah. Exactly. Okay. Questions on how this works? Are they going to show us? Oh, John Madden isn't going to come visit us on this one? I feel cheated. All right. Everybody's good with the concept of returns and allowances. So, as I mentioned earlier when we went over the chapter, or the second exam, when we present equipment and accumulated depreciation on the balance sheet, we're going to start showing a little more detail with it. Here's an example of what that'll look like, but this is an income statement example. So we have revenue, we're used to that, right? And we would say fees income, but now we're selling stuff, so we have sales. And then we would have our new account, less sales returns and allowances. So those returns would get deducted from it to come up with net sales. So we're actually going to break it out and show people, here's our sales, but we had this many returns, and we come up with net sales. And then we go on to the next section. But this is your revenue section up at the top of your income statement. Everybody good with that? It's pretty straightforward so far. We'll add a little bit more to it later. The accounts receivable account in the general ledger will always exist. You are always posting there. Because you guys saw that in the posting reference with the 111 and the check mark. We still post accounts receivable activity to the general ledger. But we're also posting it to the customer subsidiary card. Okay? We always want to make sure that if we take all the customer cards and we list the balances for each one and we total them up, that it matches account 111, accounts receivable in our general ledger. They always must match. Account 111 is referred to as the control account. It's presumed to be right first until you prove it wrong. Okay, it's the control account. Good? New language. Okay. So to do that, we're going to actually, you know how we do a trial balance to prove that our general ledger's in balance? We're going to do something at the end of every month called an accounts receivable, a schedule of accounts receivable. And basically what you do, I wish it would, I'm getting cheated by this screen. But here you go. You create a schedule and you list all your customers, you list their balance, you do the total. You come find your general ledger account for accounts receivable, find the ending balance, and you make sure that the two match. That's proving you're in balance and that your subsidiary ledger for accounts receivable matches your general ledger. Must do that. If they don't, you have a problem. You have to go find out why not and where's the mistake. Good? Don't make a mistake. It's not fun to find. Questions on that? Questions, answers? Good. Yeah. Sure. Good. So we want to make sure that the individual cards add up to match the control account. Okay. This stuff's in the book, but let's hit it because sometimes it's a little interesting. Sometimes folks they'll have a sale. You go to Macy's, they have a sale, right? Day after Thanksgiving, day after Christmas, whatever, they got lots of them. If you're a wholesaler, sometimes you'll have volume discounts or trade discounts, right? If I've got a really big customer, sometimes I'll give them better pricing because they buy lots and lots of stuff from me than I give general walk-in customers. That's called a trade discount. If you pay cash, maybe I'll give you a discount, right? Anybody been to a gas station lately? It's $4 if you pay with credit card. It's $3.95 if you pay with cash. That's a cash discount. That's all we're going to call. Okay, moving on. So here we go. Sometimes you'll get trade discounts that are multiple levels. So let's just kind of hit on that real quick. Let's do it straight. We have a sale for $1,500, but I've offered somebody a trade discount of 40%. It's a big discount. I like that. I may buy at this place. Normally you would calculate that $1,500 less 40% of $1,500, right? So the net sale is only $900. Good? Now, that's straightforward. I don't have a problem with that. However, sometimes they do multiple tiered discounts. So instead of getting 40%, you'll get, what's the example, 25% because of volume pricing and 15% because of your big customer. Now this works a little different. If you add these up, it looks like 40%, doesn't it? Am I going to get 40%?
No.
Nope. You guys are smart. You've been there. So we've got $1,500. You take 25% of that, and that's $375. You subtract that and calculate the balance, and then you take 15% of that lower amount so that it ends up being less than 40%. Okay? I wish this showed it better, but that's what's going on. So you end up paying $56.25 more because you didn't get a full 40% discount. Good? Okay? I'll come back over here.
Oh, sorry. Stay on one side.
Stand on one leg. Hop up and down. Okay. Sales tax. We've introduced the concept of sales tax. Remember this. If you're selling retail, if you walk into Macy's and you buy something, you're going to pay sales tax when you buy it. When Macy's buys those clothes from the manufacturer, do they pay sales tax? No, because they're buying it wholesale from the manufacturer. Only the end user pays the sales tax. So until it goes to a customer who's the end user, there's no sales tax. Good? Okay. So what are we showing me? Oh, in the case if you're just a wholesaler, you never charge anybody sales tax, your sales journal, you don't need 3 columns anymore. Because all you have is a debit for accounts receivable and a credit for sales. You can put it in 1 column. You saved yourself 2 columns. Because you're posting both a debit and a credit of the same amount. Everybody see how that one works? Okay? It saves you 2 more entries, right? And writing down 2 more columns worth of data every time you do something. Good? Another little shortcut. I'm working hard to save you time. Okay. Disadvantages of credit sales. That's a no-brainer. Not everybody's going to pay you, right? The advantage is you make it easier for people to do business with you. So if you've got, like I have customers who will send a driver by to pick stuff up from me, a couple of times a day maybe. And if I made them bring cash every time, it would be hard for them to bring the right amount of cash and, come over and pay me and pick stuff up. So if I give credit terms, it's easier for my customer to do business with me. And they're more likely to do business with me than the guy down the street who's going to make them pay cash, right? So that's the advantage of offering credit terms. The disadvantage is not everybody pays you. All right? And if you know not everyone's going to pay you, at some point you're going to have to write off that balance so you have a loss. Remember under GAAP we have that matching principle. You want to match the expense with the period when you generate the revenue. So under the matching principle is where we start using the allowance for doubtful accounts. At the end of every month we're going to make an estimate of who's not going to pay us, and we're going to put it in our allowance for doubtful accounts. Now, there's 2 things we know about an estimate. What is an estimate? It's wrong. And it's just a number we made up, right? But we want to look like we did, like we put some effort into it, and we look like we know what we're doing. Okay? So we're going to go into some estimates of accounts receivable or allowance for doubtful accounts. All right, here we go. This is what we've been talking about so far. If you give your customer terms, you're advancing them terms, they get 30 days to pay you, it's just an open account, right? They don't have to sign a promissory note, they just sign the invoice and away they go. Business credit cards. Anybody know what this one is? Okay. Yes, to a certain limit, to a degree. In the old days, a store like Macy's would create a store credit card. Anybody have a Macy's card? Okay, yes. And you'd go in and you'd buy stuff, and you have a credit card, Macy's would run it, and they'd keep track of how much you owed them. Nowadays, in the modern world, they want the cash, so what they've done is they've sold all that activity. Even though the card still says Macy's on it, if you look on the fine print on the back, it says Bank of somewhere or other, So it's a bank credit card now, and they're just giving the cash to Macy's. But some of these still do exist. I don't know. Well, then Macy's gets the cash right away, and they don't have to manage this whole business of issuing credit like they used to.
Okay, so the percentage of them saving money from people not paying is greater than giving the banks 3%.
Right. So they no longer have the risk of someone not paying because the bank pays them right away. Yes, they're paying a fee to the bank for that, but that's also an amount, it's a known amount. I know how much my fee is. Do I know how much is not going to be paid? Not really. I can make an estimate, but that's the best I can do. Plus, I have to employ a bunch of people to, record this, track it, approve credit, call people up when they don't pay, collect the money, apply the cash. So it's almost like its own separate business entity. Plus, there's a lot of value in getting the cash now. Cash flow. I've said it once or twice in this class, cash is king. I want the money now, because even if you have profits, if I don't have cash, I'm out of business. Cash is king. So they sold this off because they want the cash flow.
Isn't that also factoring receivable?
Factoring receivables is different. And that's where you have trade receivables and you sell them off to someone else and he collects the money. If you want to talk about that offline, we can. Was there another question over here?
I guess I was just kind of wondering what the difference then, like before they sold it off and they just ran it themselves, what's the difference between an open account and a business credit card if you're still just keeping track of what everybody owes you?
That's a great question, actually.
It's just easier for the customer.
Open account means you got to pay me in 30 days.
Oh, okay, that's like 30 days.
Business credit card, they'd let you pay over, 12 months, 2 years, whatever it was, as long as you were making that minimum payment, like on a credit card.
Okay.
So this could be longer before they get the money.
Right, okay.
Yeah,
But they charge interest.
but they're charging interest, whereas this doesn't have interest.
Right.
So do
Okay.
you project the accounts receivable for that month then?
What do you mean by project the accounts receivable?
Like, isn't that, you expect to get that minimum payment?
Oh, when you're trying to estimate your cash flow,
Yeah.
yeah, but we haven't even talked about cash flow. It's not part of your basic 3 financial statements, and you'll get into that more in other classes. But yes, you need to know what your cash flow is going to be because cash is king. Okay, yes?
In your opinion, a company like Home Depot, they send these wonderful offers that if you spend X, you will not have an interest charge, so you don't have to pay it for 6 months or 12 months. Doesn't that affect their cash flow?
No, because if you read the back of that, it's in the fine print, it's a bank who owns the credit card that you then owe them money, not Home Depot. Okay? Yeah, they're going to lure you in with no interest offer, but the minute you miss it, they're making money. And that's what they're hoping on. They're banking on that. Okay? Let's see. Bank credit cards, this is the thing that these have become, basically. And if you have a bank credit card, again, Macy's or Home Depot gets the money the next day or something, and you owe a bank the money. Cards issued by credit card companies directly. I think some of these still do exist. But these are basically the same. Let's see. Now there's a couple ways you can record credit card sales. You can record the sale and record it as a receivable until you get the money from the credit card company. But you're going to get it, how long does it take to get the money from your credit card company?
48 hours.
48 hours. So in 2 days you're going to have to go in and make a second entry to move that money out of a receivable and into cash. Most small businesses just post them straight to cash and then make sure it shows up in their checking account. Okay? If you get a real stickler, they'll make you jump through the hoops, but you're doing twice as much work because you're doing 2 entries. Good? Good. The other thing with credit card companies is there's a fee, so you're going to have to record the fee for the processing. At some point in time, it's 2.5%, 3%, ballpark. Yeah. Okay. Payment from the company is recorded in cash if you're doing it in 2 steps, otherwise you're doing it in 1 step. All right. If you're doing a lot of volume and you track your receivable from the credit card company, you know, if you're Macy's and you're waiting for millions of dollars to show up, you give it its own accounts receivable account and you track it. Okay? Sales tax. We've talked about this, right? Customers come in, they buy stuff, you charge them sales tax. Do you get to keep the money? No. You owe it to the government. So typically every month, depends on your volume. If you do a very little amount of sales, they'll let you file a sales tax return once a year. If you're busier, if you have more volume, they'll make you do it quarterly. Most people, they make them file a sales tax return and send them the money every month. A lot of people, they have you send in the money 3 times a month, 10th, the 20th, and the 30th. Great. Keeps you real busy, right? You need a whole person just to track all the sales tax and send in checks. So let's assume monthly. You've got to fill out a sales tax return. We've been tracking all this in the sales tax payable account. So we know what the balance is, right? What we owe is the balance in that liability account. It's a credit balance. We need to know sales, though, for that month because they're going to make us calculate it and show them the math. And if somebody returned something, we don't have to remit the sales tax from that because we gave it back to the customer. So you're going to take sales, subtract your returns and allowances, calculate the amount that is owed, and it'll match the liability in your general ledger account. If it doesn't, you got a problem, you got to figure it out. Okay? Here's a very simple sales tax return. This has to be from somewhere like the state of Texas because it's really simple. Oh, look, it says Texas. Okay? There's lots of business activity right now in Texas. Business is booming. Why? Because they don't have a lot of red tape. Okay, so here it is, simple. What were your sales? So this is gross proceeds of sales. Okay? Less returns and less deductions, which are your returns. Net amount times the sales tax rate of 8%. Bang, you owe us $2,188. This form's missing one line. The last line says, send it in. Okay? It always does. And your general ledger account and sales tax payable better be $2,188. Or you've done some math wrong up above. Good?
It's all online now.
Oh yeah, you do it all online. There is no more paper anymore, right? Pretty soon they'll track your phone through the NSA and they'll call you up and tell you how much you owe. You don't even have to do the math. They'll just tell you how much you owe. Good? All right, questions? Nope. Yep. Go. Good. We're done. Okay. So, before we leave, questions?
Can you just go back one?
Here? One more?
Thanks, right there.
Okay. Don't leave yet. I want to make sure we're all on the same page before we go. Yeah, you can turn that off.